Kentucky Public Pensions Authority, or KPPA, was formerly known as Kentucky Retirement Systems for over 60 years. And while our agency name and structure have changed, KPPA still employs the same great staff, which hope to offer you the same great service. Today we'll have a quick overview of KPPA benefits based on participation date and how you can do more to prepare for your retirement, whether that's next year or 30 years from now. The job of Kentucky Public Pensions Authority is to administer benefits to members of the systems operated by KPPA. Legislators create and pass the law while KPPA applies the law to this very unique and complex pension system. Under the umbrella of KPPA is three systems: Kentucky Employees Retirement System, referred to as KERS, County Employees Retirement System, referred to as CERS, and State Police Retirement System, referred to as SPRS. Under KERS and CERS, there are both non-hazardous and hazardous duty positions, while SPRS is exclusively hazardous duty. The new structure of KPPA has recently changed, which adds a board to oversee specific systems within the agency. KERS and SPRS are governed by the KRS board, while CERS has a board that governs its systems separately. The new KPPA board oversees both board of trustees. And of course, the KPPA Executive Director works alongside the KPPA Board, as well as both the KRS and CERS boards. Along with KPPA administering benefits for three different systems, benefits are also administered based upon your initial participation date, or more easily understood as your first contributions paid to KPPA. This determines your benefit tier, and we'll go into great detail about the benefit tiers in the next few slides. Now, not only does KPPA have three systems with three benefit tiers, it also has three health insurance tiers, which also are dependent upon your participation date. We administer health insurance benefits for members of the system operated by KPPA for both under 65 and those that are Medicare eligible. So as you can imagine, we don't have time to cover all of these details during this brief presentation, but these are just a few of the reasons you should jump in and start educating yourself on KPPA and the benefits you're entitled to now. The plan funding is composed of three different sources: employee contributions, employer contributions, and the return on investments. Now we'll take a closer look at the first two sources on the next slide, but let's take a minute to discuss the third, which is the return on investments. The CERS and KRS Board of Trustees are charged with the responsibility of investing their system assets to provide for the benefits of the members of the systems operated by KPPA. To achieve that goal, the board follows policies of thoughtfully growing their system's asset bases while protecting against undue risk and losses in any particular investment area. Let's examine the first two sources mentioned to better understand how the three work together to fund your retirement benefits. The employee contributions are set by statute and depend upon the type of service and their benefit tier. Non-hazardous employees pay 5% of their credible compensation, while hazardous employees pay 8%. Credible compensation is earnings that must be reported to KPPA and is used to calculate retirement benefits. For employees with a participation date on or after September 1, 2008, an additional 1% is withheld for health insurance contributions, often referred to as HIC. The 1% HIC is non-refundable. Tier 3 non-hazardous employees contribute 4% of their gross salary with an additional 1% HIC, while Tier 3 hazardous employees contribute 7.5% of their gross salary with the 1% HIC. Recommended employer contribution rates are determined by KPPA's independent actuary based on data in the annual actuarial evaluation. The CERS and KRS Board of Trustees adopt employer contribution rates necessary for the actuarial soundness of the systems, governed by the respective boards, as required by state law. The KERS and SPRS employer rates are subject to approval by the Kentucky General Assembly through the adoption of biennial executive branch budget, and the CERS Board sets CERS contribution rates unless altered by legislation enacted by the General Assembly. See the reference table on the slide to determine the employer contribution rate based on effective date by system and type of service, or you may go to the website at kyret.ky.gov and choose Employers and click on Contribution Rates. As mentioned before, KPPA's benefit structure is dependent upon a member's initial participation date within one of the systems operated by KPPA, or one of the state-administered systems which has a reciprocal agreement under Kentucky Revised Statute 61.680 and Kentucky Administrative Regulation 120. The member's participation date will determine the benefit tier, which clearly defines requirements for retirement, the calculation used to determine retirement benefits, and more. Tier 1 members are considered to be any member with an initial participation date prior to September 1, 2008. Tier 2 members are considered to be any member with an initial participation date on or after September 1, 2008 through December 31, 2013. And Tier 3 members are considered to be any member with an initial participation date on or after January 1, 2014. Tiers 1 and 2 are both considered defined benefit plans, while Tier 3 is considered a hybrid cash balance plan. As the table states, a defined benefit plan pays benefits based upon a formula, and the benefit is a lifetime payment to the member with the option to leave a lifetime payment to the beneficiary. Both of these characteristics can be applied to all three tiers administered by KPPA. A hybrid cash balance plan obviously shares some characteristics of a defined benefit plan, but it also possesses characteristics of a defined contribution plan, such as a 401k or 457. Like a defined contribution plan, the hybrid cash balance plan determines the value of benefits for each participant based on individual accounts. Now let's move on to discuss how the retirement eligibility requirements differ based upon the benefit tier structure. To retire with full retirement benefits, meaning no penalty is calculated to reduce the benefit amount, a Tier 1 non-hazardous member is required to meet one of the following criteria. He or she must have 27 years of service regardless of age, or have reached the age of 65 regardless of service. Notice I mentioned only one of those requirements must be fulfilled to retire without penalty. Tier 1 hazardous members may retire with 20 years of service regardless of age, or have reached age 55 regardless of service. Tier 2 and Tier 3 members have the same eligibility requirements for normal or full retirement benefits. Non-hazardous members must retire under the Rule of 87 or age 65 with 60 months of service. The Rule of 87 states that a member must be a minimum of 57 years old and their age plus their service must equal 87. For example, if a member wishes to retire at the earliest age allowed, they would need 30 years of service to add to their age 57, which would satisfy the Rule of 87 requirement. 57 years old plus 30 years equals 87. Hazardous members must attain 25 years of service regardless of age or have reached age 60 with 60 months of service. Tier 1 and Tier 2 members have the option to retire early or with a penalty to reduce their retirement benefits. For Tier 1 non-hazardous members, at least 25 years of service but less than 27 years of service, regardless of age, or age 55 with 60 months of service is the eligibility requirement. For hazardous members, it's age 50 with 180 months of service. Tier 2 non-hazardous members may retire with a reduced benefit at age 60 with 120 months of service, while Tier 2 hazardous may retire at age 50 with 180 months of service. Tier 3 members are not permitted to retire early and therefore must meet the requirement from the previous slide or otherwise take a refund of their accumulated account balance. As we discussed earlier, the three benefit tiers retirement calculations are based upon a formula. For Tier 1 and Tier 2, the same formula is used while the variables within the formula differ. We'll discuss those differences in the upcoming slides. So for Tier 1 and Tier 2 members, the calculation for retirement is the member's final compensation multiplied by a benefit factor multiplied by the member's years of service. For Tier 3 members, the calculation to determine retirement benefits is the member's accumulated account balance divided by an actuarial factor. Let's break these formulas down based upon benefit tier. Final compensation for Tier 1 non-hazardous members is based on the highest 5 fiscal years of service, while hazardous members is based on the highest 3 fiscal years of service. Partial years may be used to determine the average of these salaries if the partial year represents a higher monthly average in wages than the monthly average of previous years, which may contain a full 12 months of service. It's also important to note that there must be a minimum of 48 months in the calculation for non-hazardous and a minimum of 24 months in the calculation for hazardous. And as you can see, to determine the final compensation, the highest fiscal years of salary based upon the member's type of service is added together and then divided by the number of months represented over those years. To determine the member's average annual salary or final compensation, this number is then multiplied by 12. So for the hazardous example, this member's final compensation is $45,120, while the non-hazardous example's final compensation is $29,340. The benefit factor is determined by statute and based upon the system and the type of service. There are several benefit factors for KERS non-hazardous and CERS non-hazardous, so be careful to review which one you apply to your benefits. If there's ever any doubt, you can calculate your benefits on member self-service, which will use the correct factor, or you can look at your online annual statement for guidance. To complete the calculation, the member would determine their total years of service and then multiply by the appropriate final compensation and benefit factor. As I mentioned, logging into member self-service will not only project the member's first eligible and first unreduced retirement date, but it will also calculate the member's retirement benefits based on the information that a counselor would use to calculate benefits in office. It will also include any penalties associated with an early retirement. For Tier 2 members, the calculation is also final compensation multiplied by the benefit factor multiplied by the total years of service. Final compensation for Tier 2 non-hazardous is based on the last 5 full fiscal years of salary, while hazardous members is based upon the highest 3 full fiscal years of salary. Unlike Tier 1, partial years will not be used to determine the average of these salaries. It's important to note for Tier 2 final compensation that there must be a minimum of 60 months in the calculation for non-hazardous and a minimum of 36 months in the calculation for hazardous. And again, to determine the final compensation, the full fiscal years of salary based upon the member's type of service is added together and then divided by the number of months represented over those years. To determine the member's average annual salary or final compensation, the number is then multiplied by 12. So for the hazardous example, this member's final compensation is $44,000, while the non-hazardous example's final compensation is $42,100. The benefit factor is again determined by statute and based upon the type of service and the amount of service. I won't go into each tier of service credit at retirement, but notice the more service with which you retire, the higher the factor is. I do want to point out that for those non-hazardous members that work beyond their 30 years, the higher 2% factor is only applied to those years that are in excess of the 30. To complete the calculation, the member would determine their total years of service and multiply by the appropriate final compensation and benefit factor. Again, by logging into member self-service, you can project the first eligible and first unreduced retirement date, calculate the member's retirement benefits, and include any penalties associated with early retirement. Tier 3 benefits are also calculated from a formula, but the formula looks entirely different than the Tier 1 and Tier 2 calculations. Tier 3 is the member's accumulated account balance divided by an actuarial factor. The accumulated account balance is comprised of 4 pieces: member contributions, employer pay credits, base interest, and upside sharing. As mentioned before, a non-hazardous member's contribution is 5% of credible compensation plus the additional 1% health insurance contribution, or HIC. A hazardous member contribution is 8% of credible compensation plus the additional 1% HIC. And as a reminder, the 1% HIC is non-refundable should a member terminate employment and take a refund of their account. The employer pay credit for a non-hazardous member is 4% of credible compensation, plus 1% HIC, while the employer pay credit for a hazardous member is 7.5% credible compensation, plus the additional 1% HIC. A base interest of 4% is applied at the end of each fiscal year and attributable to both the member contributions and the employer pay credits. Lastly, upside sharing interest is an additional interest credit that may be applied to a Tier 3 account, assuming certain criteria has been met. We'll discuss that criteria in more detail in just a bit. To determine your monthly retirement allowance, you must divide the accumulated account balance by the actuarial factor correlated to your age and type of service. I've provided a sample of actuarial factors on the slide, but for a full list of factors, go to the KPPA website at kyret.ky.gov. Member self-service simplifies the accumulated account balance calculation and will quickly compute a retirement benefit based upon the specific variables assumed within the benefit estimator. It's important to note that these factors are subject to change based upon actuarial studies and updates to the death tables as a result. To better explain the concept of upside sharing, let's read the slide together and look at an example. Upside sharing interest is the additional interest credit that may be applied to a Tier 3 account. It is not guaranteed. The following conditions must be met before upside sharing interest is applied. The system's geometric average net investment return, or often referred to as gainer, for the last 5 years must exceed 4%. If this is true, the member is eligible for upside sharing credit, assuming he or she has been active and participating in the fiscal year. If the gainer exceeds 4%, the member's account will be credited with 75% of the amount of return over 4%. It's applied to the account balance as of June 30. Now let's look at an example. The example shown is of an upside sharing credit calculation. To better explain the calculation, let's assume a gainer of 7.5%. Remember, upside sharing is only awarded to an account if the gainer exceeds the 4% base interest. Any return in excess of the base interest is used to calculate the additional upside sharing amount. Once we subtract the 4% base interest from the 7.5% gainer, the return in excess is determined to be 3.5%. The previous slide reminds us that KPPA awards 75% of any return in excess of the base interest to the member's account. 3.5% multiplied by 75% gives an upside sharing interest of 2.63%. When we add the 4% base interest back to that number, the account total interest paid is 6.63%. To calculate your benefits assuming upside sharing, you must log into your member self-service or MSS account. It's important to calculate estimates assuming no upside sharing to be conservative, and then compare with upside sharing to show how that interest can impact your benefits. Only in member self-service can upside sharing be assumed. If a counselor prepares your retirement estimates, upside sharing cannot be calculated. A common question for members within the systems is, what happens if I leave my job? For Tier 1 and Tier 2 members, your options may look a little different than Tier 3. If you terminate your position, you may retire if eligible, leave the contributions with KPPA until you have reached retirement eligibility based upon age, or if you regain employment in another participating agency within one of the systems operated by KPPA, or you may take a refund of your account. By taking a refund of your account, you receive a one-time payment representing the money you contributed plus interest. The money your employer contributed will remain with KPPA. Refunds may be issued in a lump sum payment or rolled into another qualified retirement plan. And lastly, KPPA is required to withhold 20% for federal taxes, and you could be subject to additional taxes such as a 10% excise tax. It's also important to note that members that refund or roll over their contributions with KPPA will forfeit their benefit tier. Therefore, if they were to return to another employer under KPPA, they would participate within the benefit tier based on their new participation date. If a Tier 3 member terminates their employment, they have similar options as Tier 1 and Tier 2. They may retire if eligible, leave their contributions with KPPA until they reach retirement eligibility or regain employment with a participating employer of one of the systems operated by KPPA, or they may take a refund of their account. Tier 3 member refunds are broken into two categories: vested and non-vested. Vested refunds are for members which have at least 60 months of service at the time of separation from the participating employer. A refund of their accumulated account balance will be issued, which totals their member contributions, employer pay credits, and all base interest and upside sharing interest attributable to both. A non-vested refund is issued to a member with less than 60 months of service at the time of their separation from the participating employer. They are eligible for a portion of their accumulated account balance, which includes the member's contributions, interest, and any upside sharing attributable to the member contributions. Regardless of benefit tier, taking a refund or rollover upon termination forfeits any future benefits within the retirement systems. For Tier 1 members with a participation date prior to July 1, 2003, KPPA pays a percentage of the monthly contribution rate for medical insurance coverage based on the retired member's years of service and type of service. Each year prior to the open enrollment period, KPPA's Board of Trustees establishes the contribution rate for the following plan year. The monthly contribution rate is based on single coverage under the insurance plan approved by the Board of Trustees. This table shows a breakdown of how the percentage paid is determined based on years of service at retirement and the member's type of service. For hazardous members, the portion paid toward couple, parent, or family coverage is based solely on the amount of service the member has in an approved hazardous position. You can find this reference table by going to the KPPA website and choosing Retirees and Insurance. Tier 1 members with a participation date on or after July 1, 2003 through August 31, 2008 shall not be eligible for insurance benefits until the member has earned at least 120 months of service in the state-administered retirement system. Tier 2 and Tier 3 members shall not be eligible for insurance benefits until the member has earned at least 180 months of service in a state-administered retirement system. Insurance benefits for all members with a participation date on or after July 1, 2003 are determined by meeting the requirements of the dollar contribution plans. Non-hazardous members participating in either of the dollar contribution plans will earn a monthly contribution for insurance of $10 for each year of earned service. Hazardous members participating in either of the dollar contribution plans will earn a monthly contribution for insurance of $15 for each year of earned service in a hazardous duty position. It's important to note that under either of these plans, the monthly insurance contribution will be increased by July 1 each year by 1.5%. The annual increase shall be cumulative and continue to accrue after the member's retirement for as long as the monthly insurance contribution is payable to the retired member or beneficiary. To see current monthly insurance contributions, refer to the notes at the bottom of the PowerPoint slide, or you may find the information by going to the KPPA website. If the retired member is receiving a monthly benefit based on at least 48 months or more of service, including combined service with KERS, CERS, or SPRS, he or she is entitled to name a beneficiary for a $5,000 death benefit payable upon his or her death to an individual, estate, funeral home, or trust. This benefit is not a form of insurance since there is no policy. With the $5,000 death benefit, the member can name a beneficiary other than the person named for the monthly benefit. A retired member can change the beneficiary for this benefit at any time by completing and filing a new Form 6030 or a death benefit designation. The $5,000 death benefit is subject to federal income tax and may be eligible in certain instances for a direct rollover to defer taxes. Member Self-Service has some new tools to help members prepare for retirement, and we'll hope you'll give them a try if you haven't already. By logging into your Member Self-Service or MSS account, you can update your contact information, request an account balance letter, calculate a benefit estimate, and even apply for retirement online and upload documents such as your beneficiary designation form. MSS also includes an internal messaging center where you can access KPPA correspondence as quickly as logging in. For new hires, you can expect to receive a welcome letter from KPPA with a 4-digit personal identification number to follow. This 4-digit PIN is exclusive to your KPPA account and will be required to discuss confidential information with a counselor over the phone. For those members that are new to the agency but not necessarily KPPA, you should have received a 4-digit PIN upon your initial participation date within one of the systems. If you're unable to locate that PIN, I encourage you to go to the login screen for MSS and click Need to Register. There you will be prompted in Step 2 of the registration process to request a new PIN via email, or it may be sent to your physical address on file. Also, make sure to like KPPA on Facebook, follow KPPA on Twitter, and look for YouTube videos online for more information regarding your retirement benefits. Of course, it's important to visit the KPPA website at kyret.ky.gov for all of our publications, self-service sites, and announcements regarding your retirement benefits. Speak with a benefit counselor by calling the KPPA office at 1-800-928-4646. You may send your general questions or concerns to the KPPA email address at kppa.mail@kyret.ky.gov. Remember, this is not a secure site, so we ask you refrain from sending confidential information to the inbox. Of course, it's important to keep your email address up to date for special announcements, registration opportunities for live webinars, member newsletters, and more. And while KPPA is not providing in-person services at this time, you are welcome to drop off your forms and paperwork in the lockbox at the KPPA office. The office's physical and mailing address is 1260 Louisville Road, Frankfort, Kentucky 40601. Whether you're new to KPPA or you have been planning for your retirement with KPPA for years, we are excited to have you as a part of the KPPA family. Thank you for watching today's presentation, and we look forward to working with you in the future.